Unrivaled Nation, it's that time again to do a monthly potential multi-bagger. Today we're talking about Digital Turbine. APPS is the ticker. I think it's quite compelling with nearly 300% upside potential that you're playing for. Stock is down about 50% in just the last few weeks, so the trend, immediate term, is not your friend. But the business is growing at hyperscale, partly due to some acquisitions, but they are still growing hyperscale organically, growing nearly 100% growth organically, even with their acquisitions. Their acquisitions push their growth closer to 300% year over year. I think the valuation is really interesting at these levels, and so let's talk about it right now as we look into it. Where in order to understand what is Digital Turbine, you first need to ask yourself, well, wait a second, how does the apps on my phone get there? Now with Apple, they're selecting it, but with Android, you sort of have this different dynamic. You might have an install questionnaire when you're setting up, like where are you, your age, your geography, maybe your interests. And based on that, you will have effectively pre-installed apps on your phone. And Warren Buffett has described that screen space on your smartphone as among the most valuable real estate in the world, which makes a lot of sense given how much time people are spending looking at their phones. So historically, this is the basis of Digital Turbine. Their business model, about 80% plus of their revenue, was historically this dynamic installs business, primarily focused on the Android operating system. And you could think, let's say you're Pandora or your PayPal or your Facebook, your Netflix, and you want to make sure someone that's getting a new smartphone, let's say a new Samsung phone, a new Android phone, what they're doing is they want to make sure their apps, Pandora app, is available for those users. Or maybe Amazon wants to make sure their app is right there so it's easier for the user. It lowers the friction so that way users can just hop right on. And so what ends up happening is you have various different apps pay, and Digital Turbine effectively aggregates that cash and then redistributes it to its partners. Now they might be operating, manufacturing partners like Samsung, and they're primarily also mobile carriers like Verizon, AT&T, America Mobile, when you're looking at Latin America. And this creates sort of a win-win approach where the apps are very eager to have this prime real estate, so they're happy to pay for it, and these partners are getting effectively 100% gross margin revenue. This is a great win-win, and Digital Turbine makes their cut. And this is a very special business, partly because you don't read this that often, where they talk about we don't have any competition. So when our software goes on the device, we talked about Samsung and Verizon earlier, we are deciding we are not competing with 10 other people for that. And so when you're thinking about this, and that's music to my ears, thinking, okay, you're not facing a lot of competition for this install position. This is unrivaled, and hence the whole basis for this journey is I want to align myself with unrivaled companies because it's easier to grow. It's easier to do cool things. It's easier to do things that, let's say, accelerate your growth. And you're going to see that as I talk more about Digital Turbine in just a second. The challenge, however, is despite this unrivaled install position, is that your growth is tied to the device sales. And also, I just want to do a quick call out. Several Journey subscribers have been asking me to do Digital Turbine for some time, so I apologize for the delay. Partly it's just there's so many different companies to look at. That said, a few folks did say, look, Daniel, we do think this company is unrivaled. Here's the reason why. So I'm glad you called it out. It bumped it up in terms of my queue, and so that's the reason why I'm doing it now. So apologies for the delay. I hope this video is helpful for you. And so, as I was just talking, so you do have this unrivaled install position, but the limitation is that it's tied historically to Android device sales. That said, they are eating the Android world. This chart needs to be updated for the recent quarterly update, but over 700 million installed devices. Now that's less than 20% total global Android smartphone penetration, so there's still significant growth potential for them. And they're also thinking, wait a second, this is just smartphones right now. We could be doing televisions, wearables, maybe refrigerators in the future. So there's a lot of potential here, but management is very astute in my opinion. They're thinking a really long game here. Management's in my opinion, they've been operating on a first-class basis. And so they're thinking, hey, how do we transition from just selling the razor to the razor and the blade model? Because, that's where you can really make your margin, is a really high margin blade revenue. Whereas here it is, you're effectively making, 80% of their revenue is effectively one time historically. How do you transition the business model? And now they've successfully, through several acquisitions, they've successfully transferred their business model from effectively this app discovery upon the first day revenue being around 30% of their business model. Now recurring revenue, this blue piece of the pie, that's closer to 70% done through these different acquisitions: Mobile Posse, Ad Colony, Appreciate, Fiber. These are very clever acquisitions, in my opinion, that have the real potential to leverage their existing unrivaled position in terms of, dynamic installs or app discovery. And so, for example, one of the things, and this came from their Appreciate acquisition, which was really teeny tiny, but they're able to leverage their data, to really make this go crazy. Now you'll see their crazy growth in just a second. Is this single tap installs, where it's effectively a function where, in order to understand how do most folks find out about new apps, so about half of new app downloads are straight from the App Store. And the challenge there is when you're downloading an app from the App Store, you can see other competitors. So let's say you're Uber, you can also see Lyft. Now, the other half of, let's say, new app downloads effectively come from advertisements. Now, you could be watching a TikTok video and then there's an advertisement for, let's say, Uber or Lyft. And then and there, you're like, you know what, I really need to, get that ride-hailing service. Let me click on it. And so Single Tap, which is their proprietary software, works with various different apps like TikTok, as an example, where if you see an advertisement, you can just press, oh yeah, I want to download that Uber app, and now it's going to go straight to your phone. You don't have this really jerky experience of you're leaving TikTok to go to the Google Store, enter your authentication information, and then download it. That's a really, I just said jerky. It's a clunky experience because you were previously enjoying using TikTok. You didn't necessarily want to have to re-enter your information. Single tap is sort of like one-click buying with Amazon. You just press it and it's going to download. So that way you can keep enjoying your experience with the app. And then when you're done, oh, you've got this new app that you wanted downloaded. And they've leveraged their knowledge based on effectively their install position to target, oh, we know the folks that have the software that we could effectively market this to. And we know, effectively who would be more interested in this. And this single tap, based on their pre-existing space, has effectively resulted in ad spend that's 2 to 5x higher return on investment, or 2 to 5x higher install conversion rates than what you see with other ad spend on apps. So this sort of sounds tricky because it's ad spend on apps for other apps, but the way to think about it is you might have Uber advertising on TikTok, and the way they would be spending it, they would get a higher return on investment by spending with Digital Turbine using Single Tap, because they see which folks have Single Tap already installed and now or already have that sort of functionality because they're pre-existing install base, and so now they're going to get a higher conversion rate because you don't have this clunky interface where you have to leave the app to go to the store. That friction of leaving the app to go to the store creates, as I said, it creates fiction, so that way fewer people actually follow through and download it. Here it is, lower that friction and you get higher conversion, which means that the ad spend that they're doing is actually a higher return on an ad spend, and it's also just better app user experience. And so they're leveraging this technology in two ways, the single tap, and it's grown like crazy. They're doing it partly through ad spend, but also, effectively ad dollars going through them. But they're also looking to partner with various different apps, saying, look, the whole business model, let's say of a TikTok or a Snapchat, is to say, hey, you want to make sure your advertisers have a good return on investment. That's exactly what we're doing. And you don't have the relationships that we have with a pre-install base to make this easily accessible. And so that's a huge advantage that they have. Like, the CEO has effectively said, yeah, if Snapchat wanted to do that, they wouldn't be able to because they don't have the relationship with all the carriers like they do in terms of having this sort of pre-install relationship. So that struck me as super interesting, that it would be very hard for someone like Snapchat to build this sort of single tap download functionality, and it would be easier just to license it from them. So that does reflect, oh, there's potential, optionality here for their growth rate. But as I'm looking at it, not only are they offering this better user experience and higher return on investment, but they've already exhibited just amazing hyper growth. Where they effectively bought this, it took about 3 months to generate $1 million in revenue. Now it's doing $1 million in a week. I mean, this is going to be several $100 million revenue business. That's their goal over time. And the reality is they're leveraging the data, the information that they have with this sort of app discovery to really juice up some of these acquisitions that they've made, such as demand side platform, Ad Colony, as well as supply side solutions. So this is publishers looking to sell their ad space, which is Fiber. And so their view is, look, if we have a better perspective of, let's say, what app someone has on their phone or what their demographics are, we can really juice up, this demand side platform. And the Ad Colony represents several major brands, Starbucks, McDonald's, BMW, and you could think, oh, okay, this would be really helpful tools as well for selling these ads. So I would argue proving this Ad Colony and Fiber acquisitions, that's very early days because they were only recently acquired in the last year. Whereas, Mobile Posse and Appreciate, which is single tap, that's been longer, over several months versus just very recently with Ad Colony and Fiber. So I'm looking at this and I'm impressed with the strategy management is doing. This isn't just buying, one-off assets. This is thinking, okay, we have this unrivaled position here. How can we leverage it to create this recurring revenue? So this is very clever, thoughtful strategy that I'm seeing here. So what about the valuation? Well, you already know what you're subscribing to. So when we talk about the valuation, you look at it and it's growing just tremendously. From the last 3 years, it grew from 100 million to 300 million. And keep in mind, part of this was due to the acquisitions, extremely fast growth. But now when you layer in the Ad Colony and Fiber acquisitions, now you're talking about just continued crazy hyper growth. You're talking about a $1.2 billion run rate based on the latest quarter data. I mean, versus 300 million in revenue for fiscal 21. That's incredible when you think about it. Effectively 300% growth, yet only looking at maybe 15 to maybe a little bit more dilution. We'll see. They'll talk about that in a second. They do a like-for-like comparison saying, hey, what if we had acquired these businesses last year? And so how much are they actually growing? Not just looking at, oh, we just acquired them and, we didn't actually have them last year. So on a pro forma basis, these businesses are growing very quickly, where their existing on-device media business, that's benefited less from recent acquisitions. That's still growing 93%, but their recent acquisitions of Ad Colony and Fiber, 46% and 200% organic growth. This is fantastic. This is what I like to see, in all honesty. And they're guiding to solid profitability, saying, look, we're expecting continued solid revenue, 300 to 306 million in revenue next quarter, solid profitability of around 45 million in EBITDA. So that's around a mid-teens, EBITDA profitability figure. That said, they have taken on some debt here, so they're going to have to figure out, how that sort of gets paid off, and is that an interest expense? You're going to need to figure out how much debt are they going to layer on over time. I'll talk more about that in a second. And around 105 million diluted shares outstanding. So let's talk about some of the core risks that investors should consider. And so, because in the past videos, I would talk about the valuation framework, and I'd say, hey, here's your upside, here's your downside. The reality is that valuation framework's better at capturing what's sort of a range of upside potentials if things work out. Whereas the downside risks, those are things for you to sort of qualitatively think about and say, hey, what's the blow up risk that I should be considering at this point? And so as we consider the downside considerations, one is Android, with effectively Google owning this ecosystem, is there legitimate risk that at some point they say, you know what, we just don't like the fact that there's this whole pre-install business and they just significantly disrupt their business model. So that's a legitimate risk in my opinion. Another aspect is it's ad revenue tied. And so, yeah, they're posting fantastic numbers now, representing either brands and ad agencies looking to market or helping various different publishers with their ad space, trying to get better, return on investment there, or getting monetizing their ad space. And, looking at Ad revenue, well, ad revenue is tied to the economy, and if the economy starts turning, you might have a cyclical dynamic to it. There's also expected to be future dilution, I think, because the reality is, as of their most recent balance sheet, you're looking around 80 million in cash versus around 250 million in debt, around 300 million in acquisition-driven liabilities. That's primarily tied to Ad Colony, and that's effectively saying, hey, we made this acquisition, and we are going to pay this additional cash based on how you perform. And so they need to figure out, okay, well, wait a second. If we're only doing, let's say, 200 million in EBITDA, how are we going to fund this 300 million in acquisition liabilities? So some of it can come from cash, but that's going to be tricky. So I fully expect there to be more dilution in the future, and that's just a question that investors are going to have to think about, as they look at this. Maybe they do it through debt. So those are the different elements to consider. Another key aspect to think about is the trend where the stock price has broken lower. Could it continue to go lower? Absolutely. It's just something to be mindful of. This is recently, I've been talking about Stanley Druckenmiller and how did he get ahead, and it was by his approach, I think, and how he never had a down year is he just had a lot higher turnover than, let's say, I'm comfortable with. And so he would only own things that were going up. So the second they started breaking down, he would get out of them. And so he'd say, look, out of thousands and thousands of securities, I can just find things with favorable charts where it's just favorable, or the stock price is trading above its 200-day moving average, for example. And when you look at what's going on with Digital Turbine, it is down about 50% from its high just a few months ago. So there is some turbulence going on there. The trend, at the very least right now, is not your friend. It's something to be mindful of. And ultimately, this is an M&A driven approach where there's greater risks on do they actually deliver on quality. Will they make sure that the recent acquisitions actually work out or remain profitable or continue to grow or are well integrated with their existing solutions? So those are the key aspects that investors need to consider. And the fact is that they do have a lot of effectively liabilities that they're going to have to manage in the near term. So that could continue to weigh on the stock as investors say, hey, how are they going to fund the acquisition-driven liabilities? Now, as I think about this upside potential, now this isn't perfect because I'm not layering in the potential interest expense, for example, that they'll have to pay. But as you think about this, just ballpark figure, what a potential buyer might consider as they look at this. I mean, first of all, it's just incredible to think. This does. You should give a lot of credit to management in terms of their business chops to be able to grow a business from around 100 million in revenue to 1.2 billion in revenue in just 3 years. That's incredible. You're looking at somewhere, ballpark figure, let's say 5 billion, maybe 6 billion, depending on how much dilution you're going to be looking at. So $5 to $6 billion for, a company that's, let's say, 1.2 billion in sales, growing at an organic growth rate of 100%. And so I'm just thinking, wait a second, how many companies trade at 4 or 5 times, 3, 4, 5 times sales that are growing at 100%? Not many. So then the next question is, well, wait a second, well, what's their margin profile look like? They're guiding to EBITDA of around 15%. I'm putting a range of 10 to 15% to be conservative. Part of this is the fact that it doesn't include the interest expense. Slap on a tax rate, and you sort of have an implied earnings multiple of 34 to 60 times relative to their growth rate, their organic growth of 100%. That does smell very interesting, and that's part of the reason why I plan on buying shares later this week. I might just start with a position, maybe a 0.5% or 1%. So then the next question is, well, wait a second, what's your ensuing growth rate in the years ahead? They're currently around 100%. I'm assuming it decelerates significantly. Part of it's just demand side platform. Part of it's it's based on the number of new devices sold. Part of it's based on their supply side platform. Like how fast can their growth be in the years ahead? So 100% organic growth now. They could surprise again next year. So I'm saying a range of 30 to 50% annualized in the years ahead, and a multiple range of, let's say, 15 to 25 times in, let's say, 5 years out. How to think about this. So based on that, you're getting nearly 300% upside. Throw in a little bit of cash that they're going to be generating. They're either going to be using it to buy, to pay down debt, or it's going to be actual cash flow that, depending on their debt covenants, that will accrue to shareholders. Maybe they can rebuy stock if they want to. So I look at this and I think it's quite interesting. I'm saying 300, nearly 300% upside is sort of what you're playing for here. Maybe even more if they can deliver faster organic growth. We'll see. Maybe if investors say, "Wow, this does seem like an unrivaled position. This should be a 30 times multiple," and you pay even more for it, and there's even more upside. So that's how I'm thinking about this. Like right now, I'm looking at 200, 300% upside, maybe even more. You do have some core risks to consider, like maybe Apple, excuse me, not Apple, but Google effectively disrupts the whole business model because they own Android. You do have the short-term risk, and maybe that's the reason what's driving down the share price in the immediate term is effectively this concern of dilution and the future shares that will be issued. Also proving their strategy with this mergers and acquisitions. Okay, all these mergers, it's going to work out. So that's another element to consider, as we look at this. So I hope this video has been helpful for you. And if you have some thoughts or questions, why don't you ping me in Discord? I'd love to hear, and have a full conversation there, because I will create an exclusive channel for Digital Turbine in the exclusive Discord community. Thanks so much for being part of Unrivaled Investing Journey. I'm grateful to be on this journey with you.